Welcome to the Depth Dive. We are jumping straight into the first week of January 2026 using a market report from ViviMoney Daily to cut through the noise. And what we're seeing is a market being pulled in, well, three different directions at once. You have stubbornly high interest rates, you have this weird seasonal liquidity stuff happening, and then this incredible split where money is flowing into high-risk AI stocks and, at the same time, into super safe gold.
That split is really the whole story right now. I mean, the macro picture is still defined by restrictive rates. The U.S. 10-year Treasury is just sitting there.
Right around that 4.1, 4.2% mark?
Exactly, around 4.17 to 4.19%. And that number puts constant heavy pressure on valuations for any high-growth company.
So everyone's just waiting.
Everyone is waiting for the big data points. The upcoming ISM report, and especially non-farm payrolls, that's what will give us a clue on what the Fed does next with rates.
Okay, let's unpack some of this. There was a detail in the source about liquidity at the turn of the year. It sounds technical, but it seems really important.
Oh, it's critical. What you saw on December 31st was the New York Fed basically managing a huge plumbing issue. You had the Standing Repo Facility, the SRF, lending out a record $74.5 billion.
So pumping cash.
Dumping cash in. But at the exact same time, the overnight reverse repo facility was sucking cash out, over $100 billion.
So this is just a year-end technical thing, not a crisis.
The market sees it as a successful, managed technical event, not a crisis. But it does show how much intervention is needed just to keep things smooth.
And what about the mood? The VIX, the fear index?
The VIX is pretty low, actually, around 15. That suggests some complacency, but there's definitely upward risk. And in crypto, the fear and greed index is up from extreme fear, but it's still just in fear territory, cautious.
Okay, so this is where it gets so interesting to me. If the mood is cautious, where's all this money going? It's that divergence you mentioned. You've got the big ETFs like VOO and QQQM sort of oscillating at high levels. But the real action is in AI.
Absolutely. The conviction is all in AI infrastructure. Investors are basically betting that AI is so revolutionary it can defy those high interest rates.
So a stock like NVDA?
NVDA is the perfect example, closing recently around 188. But it's also about specific news. Look at Coinbase, CoinIN. It jumped to around 254 after some M&A news.
So company execution still matters.
It matters a lot. Now, on the other side of that coin, you have crypto. Bitcoin's extending its run, sampled near $94,000.
Wow.
Yeah, but it's facing some resistance up around that $95,000 to $98,000 level. This is mostly institutional money from the new ETFs. It is not a retail frenzy.
And then there's the other safe haven, gold.
Right, and gold is hitting recent highs, close to $4,500 an ounce. It's a fascinating trade because it wins on two fronts.
So?
Well, if the Fed hints at cutting rates, that's good for gold. But if geopolitical risk flares up, like with Venezuela, that's also good for gold. It's the ultimate hedge right now.
So investors are literally buying lottery tickets on AI and at the same time life insurance with gold.
That's a perfect way to put it. It shows nobody has real conviction in any single outcome.
So what's the takeaway? What's the strategy in a market like this?
The source is pretty clear. The strategy is defense first, batch buying, and strict position management.
Okay, break that down.
Keep your core positions in broad ETFs, your VOO and QQQM. For the big AI names like NVDA, you buy in batches, not all at once. Use the volatility, and you have to use cash buffers or options to manage your downside risk.
And for the hedges, gold and crypto.
Gold is your systemic risk hedge, a long-term insurance policy. For Bitcoin and Ethereum, the advice is small, phased entries with very strict stop losses. You have to respect the momentum, but also the fear that's still under the surface.
So to sum it up, we have managed liquidity, high rates causing pressure, and this incredible parallel race between AI growth and safe haven assets.
Precisely. And that leads to the one thing for you to really think about. The report notes that the Bitcoin to gold ratio, it has actually decreased significantly from last year.
So gold is getting stronger relative to Bitcoin.
Exactly. Even though both are doing well, gold is gaining ground. So you have to ask yourself, what does that really tell you about the market's conviction? Is the real story the exciting growth in tech? Or is it the deep underlying caution about global stability that's making gold shine just a little bit brighter right now?
That is the question to consider. Keep an eye on that upcoming jobs report. It could be the catalyst that finally breaks this stalemate. Thanks for diving deep with us.